Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over Twitter, go over some information. I'll give you my financial opinion as we go through it together. If you guys need any help with anything in terms of commodities, definitely don't forget to sign up for the finding-value.com Platinum membership. We do have a discount called Discount for those who are new to try it out. And it's a larger discount if you sign up for the yearly membership. All right, so let's dive in here. Let's see what I've got. And if you want to follow me on Twitter, it is at finding_finance. So I'm going to start with Jim Rogers. Jim Rogers is a famous commodities investor. And when asked what he would go long on for the next 3 years, Rogers' response was simple. First, silver, then maybe agriculture. I met Jim Rogers in 2004. Brilliant, charming, funny. Don't fade him. Giving silver his blessing is huge. Jim Rogers, he doesn't really say much of like what to invest in the majority of the time. So to actually hear him say that silver looks good, you should probably take notice. And I'm even taking notice because I already have a pretty large silver stack. I've got some silver companies, but you know what? It's always good to be getting others' opinions. And this also means that he thinks that we are in a certain stage of the bull market. I think what he thinks is that we're kind of in the first 25 to 50% of the commodity bull market, somewhere in that range. And maybe we haven't had the pullback yet in, say, uranium and oil. Maybe it's ending. It's hard to say when the first wave ends, or I should say the first wave, then the second wave is the pullback, when that second wave pullback ends and when the third wave begins. I think that we're close, but close could also be within 20, 30, 40% of a bottom in terms of close being time frame. So I do think that we are less than a year for sure, probably less than 6 months, and it very well could be right on top of us where we start a third leg or a third wave, an Elliott wave, for the move higher. And that's when a lot of other investments in commodities do quite well, like silver and like gold. So there's that. We've got Eric Nuttall. He's saying Eric Nuttall believes that the oil market is already undersupplied before potential Russian production cuts. Watch to find out where he sees WTI at as he forecasts a bull market for oil over the next 5 to 6 years. And that's your investment cycle, basically, how long it takes for investment to come in and supply to respond. The difficulty I have here with myself, even like trying to think about this, is I don't know if we're going to get a supply response from oil that is great enough to actually increase the supply of oil from where we are today or where we are in 5 or 6 years, somewhere from today to 5 or 6 years. So we need to put on massive amounts of barrels of oil to overcome the supply decline rates and then actually grow on top of it. So if we're declining, let's just say we have 100 million barrels per day and we are declining around 6 to 8% per year. On a 5-year time frame, 6%, you have to replace 30 million barrels a day, every single day. And I don't know if we've got that much in the tank left in terms of production growth to offset supply declines. So that's where I get a little bit choked up. Are we at peak oil? Are we not? I think we're probably pretty close, but I'm not 100% sure. I don't think anyone knows until you look at the production figures backwards. I do think that we're very close. We could have already hit it in 2018, and we just don't know it yet. But I do think that we're riding on the top here. And I don't know what this curve will necessarily look like. With underinvestment, the curve could be steep on the back end with the decline rates and production really falling off. If this production falls off quickly, we could see a price spike that remains elevated for the rest of our lives. if we have a long plateau where production peaks for a very long time and stays at the same rough levels, we could see prices continually go higher, but we won't see that shock. I don't think it'll just continue to go up steady, where demand gets basically crushed somewhere in the world as the supply cannot grow. And I don't think we're going to go to 200 million barrels of production. I just don't think we have it in us. So it's going to happen probably within the next decade. Peak oil, that is. Rick Rule also says the supply of oil and gas is going to continue to be constrained for most of my life. I agree with that. I agree. So here's some other cool things. This is silver versus oil, and I did this. Maybe he watched the channel. I don't know. But it's bottomed and has been in a new uptrend for 5 months. We are at the start of the next big bull market in silver, not the end. And this is the relationship of silver in relationship to oil, the ratio. Silver, as this goes up, silver's outperforming. You can also see, if you put these tops together, a very large megaphone pattern where this thing could go way up here and peak out somewhere, up in this 0.7-ish range or something like that, which would suggest that we could see a vast outperformance of silver. This also aligns very well with what Jim Rogers is thinking about silver as well. I'm obviously a silver bull, platinum bull. I'm a metals bull in general. Even the base metals I'm bullish on: aluminum, nickel, copper, you name it. It doesn't really matter. Tin. I think they're all going to do incredibly well, and they're all going to have their time in the sun at some point. And which one's going to go first, second, third, fourth? Guys, I don't exactly know the exact timing of everything, but I can tell you, when you have these setups that are real low like this is where I pile in. Where you have these ratios, one's really low and they start to move. I would assume that SILJ would also be another one to be looking at. It's an ETF. And then the individual companies that would provide even more leverage on top of all this, if you guys are interested. Here's another one that says, been using this chart. It's another Huey versus XLE. I'm just showing you guys more data. So this is Huey. Huey is a gold bugs index versus the XLE. XLE is the Energy Select Spider Fund. And you can see that we are very low for precious metals, and that precious metals could be turning to move to the upside. If you pay attention to the channel, I talked about a lot of different ratios, how we were comparing a bunch, and that GDX and SILJ looked pretty good for potential investments. Coming on down, he said, I brushed off the dust of some older versions of the comparative inventory analysis script. This one adjusts for inflation and considers all petroleum stock data except the SPR. So when you take out the SPR and you just look at commercial inventories, it's saying that we're basically right where we're supposed to be valued. The problem is we basically decimated the SPR for them to hold this commercial inventory at that same level. So who's right? Are the people who are in the bull camp saying, hey, look, we just ate through a gigantic amount of strategic petroleum reserves, but the commercial inventories are roughly the same as they are at $70-something barrel oil? Now, I don't think anyone's necessarily right or wrong, but the question I think everyone should be asking themselves about oil is, what did it take to hold this inventory here? And are those conditions going to remain the same in the future? So if it took a whole bunch, hundreds of millions of barrels of SPR release to hold this commercial inventory where it's at, if it took China to be on lockdown, if it took, we'll say, Russia's been producing at pretty high levels, I think in the future, whenever this future will be, months, 6 months, less than 6 months, 1 year, I don't know the exact timing. I think when China comes off lockdowns, you're going to see a massive growth in oil consumption because they've been locked down. They're going to be like, screw this, get me out of here. I'm going to be buying a bunch of stuff, binging on going on vacations and trips, much like America did. And then you've got Russia, where all of the energy service companies from the West basically left. And now they're going to have to sustain production on their own. And I don't think they're going to be able to sustain it at the levels that they were having before. So I think production will go down there. And then I think the SPR, Strategic Petroleum Reserve releases, will end. And when you add that all up, we could see a dramatic increase when all of these, these things merge together, the confluence that we see with all this. I think that the inventories will drop dramatically to the left here, and then your pricing should go up. So your stocks are here. You're going to drop to the left, and then your pricing is going to go up. So if you go to the left because your inventories are dropping, and we could drop quite dramatically, then we're probably going to see pricing move way on up. That is what I am expecting. Now, the timing of that is going to be the difficult part. Do we go a little bit lower in December? Or do we hold where we're at? Or do we just ramp higher? I'm not exactly sure the exact path in the short term, but longer term, very bullish is my stance. Going here, it says global crude oil and products inventories remain in a tight range. The SPR releases propping up commercial inventories throughout 2022. Supply response continues to be muted. Volatility extends timeline for new supply investment. And demand continues rising as Asia reopens. So what we have here is this 2020, the big inventory. That's where we got the cheap oil. 2021, we just ate through it all. And now with the Strategic Petroleum Reserve releases, 2022 has been a pretty even inventory level at a very low level. This is a very low level here. So the question, again, is, are these inventories going to get eaten up in the future when the SPR stops and China reopens? My guess is yes. But that's what the data looks like. It says, very large, very long-term, very valid patterns with enormous potential fascinates me. Here we have the largest valid rising triangle I've ever seen. And I posted this back a couple of, 2021. So a year or two ago. I was posting this saying this could be a monster pattern. I talked about monster patterns. This is a monster pattern, and we are very low in the monster pattern. This is First Majestic Silver, big, huge pattern that is developing. And it's just taking time to play out. Still very cheap, still looks good, and silver looks good. This guy says the recession is so bad. This is Desert Hills Premium Outlet Mall. People in the neighborhood were selling parking spots in their yards for $20. Lulu had a 2-hour wait like a theme park, except the ride is you spending $1,000. 26 shopping days left. The good stuff has been gone for weeks. That's crazy how busy the shopping is at this particular place. And I thought, it just doesn't seem like we're in a recession. I see people everywhere spending tons of money, myself. Base industrial metals and oil may take a hit on news of these protests in China. And that's what we saw today. This is 11/28. We saw a hit in oil, and then it just came back. CCPZ government has been far too silent. The market will be anticipating a harsh crackdown, in my humble opinion. We shall see soon. Maybe this accelerates them reopening. I don't necessarily know. But this is delaying some of that demand for oil and maybe some of the demand for other industrial-based metals. 75% of the S&P 5 or 75% of S&P debt is fixed versus 40% in 2007. Average maturity of 11 years versus 7 in 2007. 90% of U.S. mortgages are fixed versus 65% in 2007. And I just wanted to go over that. I thought that's a cool statistic to know. And I don't think that I think that the leverage in the system isn't the same as 2007. The debts aren't adjustable rate mortgages. It says all the lithium mines currently in existence cannot produce this much. Better start digging. So this is in red. The lithium mined to date is all of this lithium here. It says in the yellow, the lithium needed for clean energy transition. This is a lot. So the yellow is what we need to mine. This is everything that we've mined so far on Earth. And we've got many, many, many multiples more that we need to mine of lithium in the future. I do have a couple of investments in lithium. It's not a ton, but those are I've got a couple of horses. It says humans mined 700 million tons of copper over the last 5,000 years. The same 700 million tons will need to be mined over the next 22 years to meet the energy transition targets using wind, solar, and electric vehicles. Lots more copper needs to be mined a lot faster at lower ore grades. So when I see these types of numbers, I know they're mind-blowing, at least to me they are. The number of tons of copper that we need to do in a very short time frame means that we need to accelerate our consumption of energy in order to do that. Because the 700 million tons of copper over the last 5,000 years, we're at ore grades, many multiples of where we're going to be in the next 22 years. The ore grades are declining, and the exponential ramp of energy use to get those ore grades out of the earth is unfathomable. And if we are stuck with oil production at a certain level, if I think that we're at peak oil or something like that, I think oil prices are going to go ballistic. So when I look at all this and I see the shortages of all these different materials, the first thing I think of is, man, that's going to be a lot of energy use. I don't even think about the pricing of copper because you can't really store copper. It's too bulky if you're going to try to do it yourself. But then you also have the mining companies, and I don't know if they're going to make more money or not because the price can go up. And I know people say, well, the price can go up until the miners are profitable, but you're not going to be more profitable necessarily, especially with declining ore grades. I would think that the profits would flow all to the energy that is short. So people will be fighting for energy, and obviously they'll be fighting for the metals too. So the way that I always thought about this is, under that scenario, energy itself, the oil itself, will be ultra valuable, and all of the metals that you hold in your hand will also be ultra valuable, and anything that has embedded energy into whatever products it is that you already own will be ultra valuable because it's going to be hard to replace it. So that's how I've always viewed a lot of this stuff. It says the U.S. economy is quite a ways from recession. Looking at the labor market, we should expect recession to begin when claims are 418,000 given the past couple cycles, and today working age population size. Even a relatively fast deterioration would take nearly a year to get there. So in this guy's opinion, in order for a recession to occur, you need to hit the threshold level of 418,000 on unemployment. But right now we're very low and it's going to take some time to get back up there. He says, in his opinion, that it would be at least a year away. Now, obviously, I'm not going to say anything. Things have changed quite quickly. I didn't think mortgage rates I didn't think mortgage rates were going to go up that fast, but they did. So I remain open, but that's his opinion. And I think it's a valid opinion. This is Denison Mines. This is his opinion that we'll eventually break out of this flag pattern and roll on up, just like we did with this similar pattern back in 2004, we roll on up. Now, I don't know if we're just going to roll higher, if we go a little bit lower, do a false breakdown and move on, shoot on up. I do think that the general direction is right in that general time frame. It says, I thought this was funny. So they've got all these people down here. That is the riots. And he says, look at all these Chinese oil bulls. They refuse to let Z hold oil down any longer. Oil wants to trade free. And the lockdowns very well could be a way to control the oil price if we are in a very tight oil market. Some of these do seem kind of weird how they're doing their lockdowns, and there's not really anybody, passing away by it or anything. So that maybe he's right. I kind of agree with it to some degree. Here it says, are we facing an energy super cycle, Josh Young? And it says over the next 5 to 10 years, And beyond that, I don't know that anyone can really predict past that, but the future, the trajectory right now is very positive for oil. So that's his opinion. I agree with it. Obviously, I put this one, the Bitcoin. It is kind of an interesting chart. I do like charting quite a bit, and it's coming to a corner. We'll see which way this thing breaks. There is fractals that say that this could potentially be a bottom and that we could roll higher. We'll see. This is Athabasca oil, have potential target of 850 when oil is grinding higher. This is called a point and figure chart. You can see point and figure charts, and you can still draw a downtrend line through here and then the break of the downtrend. It's consolidating at its current point, but the price objective, given this point and figure chart, is $8.50. It doesn't mean that it will stop there either. It could obviously go far higher than that, depending on how it goes up and where the price of oil eventually goes. This one I thought is pretty cool. It says, let's see, obviously maybe you are right or wrong, but at the end, for sure, one of them would not be true. We are at the retest stage, in my opinion, and need to convince 10-year bears camp to fly to the moon. What this is, and we've charted this before, a lot of us, including Scott, myself, Casper, we've all charted these big charts out. We all come to the same conclusions with this channel. And what could be a potential move is we have a false breakdown, which is the slingshot cheetah pattern, where you break down and slingshot higher. And eventually, we'll work our way up to this point up here. It's about 10 years away. Think of it as the bottom of 2018, all the way up to about 2028 or something like that, or a little bit before. That's around 364 to 444 of price of barrel of oil. Now, I don't know if it's going to get there. I would say that it has a strong likelihood to get to that price, and that would be at a ratio of 1 to 10 against gold or slightly lower. That all makes sense, and gold being at $3,000-$4,000 an ounce, it all kind of adds up where it's possible. It doesn't, the probability of this happening, I think it's highly probable and very much possible. I'll put it that way. Coming on down. Yeah, I've already shared this stuff. So that's what I've got. I'll end it there, guys. I went over a lot of oil. I'm still a big oil bull, still a big precious metals bull. I play it the physical route for the majority of my money. I am going to be dipping into some of the mining companies, and obviously I got royalty companies, and that's how I'm playing all this. Hopefully it works out, and I get a really fun ride out of this thing. You guys, I really do enjoy investing. It's fun to me. I like looking at this stuff, and it's also fun being right. If you see the account value go way up, that's always fun. Obviously, it's not fun riding through volatility, seeing it go down some, but that's part of the game. You just got to deal with it, learn what to do, and I'm excited for what's coming. And I'm excited for precious metals. I'm excited for uranium. I'm excited for oil. I'm excited for some of my other stuff like fertilizer companies and other stuff that I'm in. And I'm getting anxious here. I'm getting anxious. It's fun. So that's what I've got. Hopefully you guys enjoyed the clip. Give me a thumbs up. Subscribe to the channel if you haven't. Subscribe to the website if you'd like. Again, you can use the word discount in the coupon code and get yourself a discount if you'd like. All right, guys, we'll catch you later. This is Finding Value.